The oil and gas industry is capital intensive, that much we know. And when the price of an oil barrel drops from $100 to less than $50, the economics of many projects become a tall order. In fact, when oil prices slide below $50, just one-third of $270 billion worth of potential investment in sub-Saharan Africa makes economic sense. The oil price environment puts enormous pressure on exploration and production companies, which cut down drastically on their capex budgets, on governments, which lose significant oil and gas tax revenues, on service companies, which are forced to lay off thousands of employees, and on financial institutions, which have less capital to fund projects. For Africa, the challenge is ever greater because it vies with other regions for the attention of capital markets. According to the IEA, Africa will account for just 10% of the $22.4 trillion that will be spent on oil and gas globally between 2014 and 2035. Assuming the continent were able to draw as much investment as, say, Europe, then it would commit nearly $1 trillion more in upstream, almost $500 billion more in LNG projects, and an additional $290 billion in pipelines and storage. The need for Africa to compete for oil and gas capital has never been greater. So what can Africa do to become more attractive? With today's oil price environment, upstream companies, especially publicly listed ones, are increasingly focused on effective corporate strategy and portfolio management, prudent capital allocation, and successful project implementation. For these companies, strategic decisions to divest, invest, and retain are critical to maintaining a healthy risk profile and access to a wide range of financing options. In oil and gas, the size, cost, and complexity of projects have gotten so high that improved performance and delivery have become crucial to securing investment. Enormous cost overruns and missing critical milestones result in failures to control project economics, which drags down company performance, increases risk and borrowing costs, and results in a loss of shareholder confidence. For governments, addressing regulatory challenges is the key to reducing investor uncertainty. Close management of health, safety, and environment standards help avoid cost escalation, as do balanced local content regulations that give adequate consideration to project cost. Improving basic infrastructure for water, power, rail, road, and accommodation gives operators the resources to execute projects on time and on budget. Another way to improve Africa's investment profile is reducing geopolitical challenges. According to an EY survey, 55% of respondents ranked political instability as the biggest barrier to investment in Africa. Diplomatic and security issues, especially sectarian insurgencies in North Africa, have also been major deterrents to investment. Failure to resolve these conflicts tilts the attractiveness of projects to the negative side.